Hi everyone, my name is Sean Heidemann. I'm the designated broker and owner for Position Realty. Every month I do a Phoenix market report for each month. This month I am doing it for the month of August. We're currently in September, and so I'm going over the statistics from August. And if you guys like the videos that I do, please make sure you subscribe down to the bottom so that whenever I have a new monthly report that comes out, you'll be notified through YouTube, and you can watch the videos each month and see how the market changes each month. But let's get started here with the report. The first slide here is based on appreciation on median sales price. So up here is the peak in May of 2022 at 480,000 based on the median price in Phoenix. And this shows September of last year, we're at 444,000. And now we're here at 439,750. So that's a decrease of 1%. This here, 442, this is a projection. So if the market rises 0.5%, we would break even in October. So next month, if the market rises just a 0.5%, then we'll be at a break-even point, which I know I've said in previous reports that we were going to get to that, but we haven't got to it yet. But hopefully by the end of the year, we'll break even, and then we'll start to see some more appreciation again into the market. So this is based on the monthly average calculation. So September and price per square foot. Sorry, monthly average and price per square foot. So September 2022, this price per square foot was 279,000, and currently we're at 286,000. So based on the monthly average, we're actually up 2.6% in the market. And then here's seasonally priced in Phoenix single-family homes under 225,000 square feet. This takes out any changes for luxury markets and other larger properties. So when you have those properties within the graph, then you'll see these wide strings and spikes. So this is kind of more narrowed out. So this shows you from September of 2015 all the way up to 2019. Shows you these are typical years between 2015 and 2019. This is typical appreciation. This is the Cromford Report Index versus annual appreciation. Cromford Report helps predict, or the Cromford Market Index helps predict the future of annual appreciation. So as you see here, when the Cromford Report starts spiking up, then we start to see appreciation. Once again here, historically, Cromford Report Index increased, and then we saw appreciation. So it was increasing, and now it's starting to level off. So it's kind of maybe a false appreciation indicator there. But we'll have to watch this and see which direction it goes. If you're planning on buying a property in the short term, I mean, so to flip it and not own it for too long, then you might want to wait and watch this indicator, see if it starts heading back down again. We're going to go into a buyer's market and start seeing prices go down again, or it might start spiking up and we'll start to see appreciation again. But short-term buyers, I would hold off. If you're buying a long-term property, then you're going to hold it for several years, and Phoenix is a healthy market. We have lots of employment coming into the market, and I wouldn't necessarily worry a whole lot about that. Here's another chart. This takes the actual median versus a 5-year appreciation historically. So if Phoenix, instead of having these wide ups and downs that we've had over the years for appreciation, if we just had a steady 5%, we would still be right around 390,000. So probably approximately $10,000 less if we just had a normal market since 2001 and now. So this shows that we're probably right around the prices where we should be based on incomes and inflation and that sort of stuff. Now mortgage rates, they have spiked up. The conventional loan is at 7.22%. and FHA is at 6.75. Like I was saying, once interest rates get around or below the 6% mark, and we're really going to see the market take off, and more buyers are going to get in the market. There are a lot of buyers on the fence right now that are just waiting for interest rates to change, and so probably now is the best time to buy, less competition, and so there's going to be a big influx of buyers, and you can always refinance it later when interest rates go down. So when mortgage rates are high, it always restricts the demand. So see this girl here, she has the hose kinked and there's no water coming out. So there's little demand. Now this shows a seasonal trend. So our trend of new listings spikes up here first couple weeks of the year, and then it goes down, and then now we're kind of more around this mark here. So we're going to start to see new listings go down. So which is normal. Now let's talk about the treasury yield and this thing called inversion and the recession. So when is the recession coming? So once the recession comes, then we'll start to see mortgage rates go down. Typically, unemployment also goes up during a recession as well. And so this inversion here, so whenever there's an inversion, meaning the 2-year treasury is higher than the 10-year treasury. So if you think about it, you should get more interest or more income on if you bought a 10-year treasury because you're holding it longer as opposed to a 2-year. So now there's an inversion, so your 2-year interest rate or your yield is higher than the 10-year. So whenever this happens, then a recession is triggered and mortgage interest rates go down. So this shows you unemployment. So during recessions, unemployment usually goes up, but our employment is still very, very low. So we're not quite in a recession, but we do have the inversion. This slide shows historically the 30-year mortgage rates. You see here in 1980, it was at 18.4%, 16.4%, 10%. We're only at 7.7% right now. So historically, we are not in a bad position to still buy. I'd say if our rates were 18.4%, we'd be in pretty bad shape now. Granted, back then, incomes and the price of homes were a lot lower, but also wages and other things have gone up to mitigate the affordability for the market. So if you're able to buy, it's really not that bad. A recession will be coming soon. Mortgage interest rates will be going down sometime in the near future. I don't have a crystal ball, so I don't know. But if you're looking to buy and you're able to, I would go ahead and pull the trigger. So unemployment, this shows for the last 23 years. So unemployment, the 6.3%, 10% in 2010. And then we had a big spike, which really wasn't a recession, but during COVID. And now our employment is actually pretty good. It's 3.6%. This slide shows the 30-year mortgage rate over 14 years. The last 14 years, our mortgage rates have been pretty normal. It's been pretty low, so that's why everybody's kind of shocked at the high interest rates. It's kind of interest rate shock, but anybody that was born prior to 2000, or not born, but in their adulthood during these years, they remember higher interest rates. Owner-occupied is back to normal, which I showed on the previous slides. We're still at a 73 to 75%. We're at 77.1% right now. Normal investor iBuyers, second homes is 8.9. Investors, those are your flipper investors, it's 12.8% of the market, and there's not even, the iBuyers are not even on there. It's pretty low. It's Cromford Market Index. This shows if we're in a seller's market or a buyer's market. And so the supply is low here. So, and then demand is low as well. So this makes up right here that we are still in a seller's market. This shows the Cromford Market Index based on history. So here we are in 2003. And like I told you, we want to watch this thing here. The market index starting to head back downward because the interest rates have stayed high for several months now. So hopefully we'll have some relief there. If not, then we're probably going to start going to a balanced market, maybe even buyer's market again, depending on how the winter months is going to go. Historically, September, with the contract ratio, we typically see them come down for the holidays, as historically you can see. So contract ratio is the number under contract divided by active times 100. And then Greater Phoenix active supply. So the supply of listings is 10,099. And so as you see that the supply is low. And closings involving seller paid closing costs. So 41% of all transactions included some sort of closing costs. So closing costs are still on the market. You can still take advantage of that. It just depends on how much sellers are willing to give. It's a lot less than it was in January. It's $7,500, which can go towards buying down your interest rate as well to make your mortgage payment a little more affordable. Granted, this is just an average, so it could be higher, it could be lower, depending on your realtor or their negotiating skills and how much they're able to get you. Closings over asking price. There is still closings over asking price. It's 22.6% of all transactions have closed over asking price. And then medium days on market prior to contract, it is lower now. And in January is at 56. We're at 21 days. So if you list your home, the average of the market, each neighborhood is a little bit different. Might be higher, might be lower, but you can expect a pretty quick sale in the market today at 21 days. So that is the end of the report. Thank you for watching. Please remember to subscribe to my channel below, and also have under the description of the video, I have all my contact information, social media information, my contact, my calendar on there. So please message me if you have any questions. Thank you for watching.